Hello, what I'd like to talk about in this video is the third deliverable, which is the last deliverable prior to the final report being due for the project. Now this third deliverable is the after-tax cash flow worksheet from your Excel file. Now with the first two deliverables, you have all the components necessary to do the after-tax cash flow worksheet. So what I'm looking for is we have our input worksheet, our revenue worksheet, expense, investment, and now depreciation. And I'm looking for the after-tax cash flow worksheet. Now all of these numbers are built from the prior worksheets that you put together. So we've got the investment worksheet, that these feed directly from the investment worksheet. We have our revenue worksheet and our expenses worksheet. So it's very easy to compute our before-tax cash flow, including investments. And this number is we can compute an internal rate of return on this number. Now, I like to compute the before-tax cash flow excluding investments because that's where we can compute our regular taxes. And so we've got this number, we've got this vector here, which simply backs out the investments. So it's this column F, depending upon how you do your signs, you can either add the investments or subtract them if you're bringing in your investments as a negative number. So we have this number, we take out the depreciation. The depreciation comes from the depreciation worksheet. The difference between the two is our taxable income. This is our regular taxable income. We compute our income taxes on it, and it's simply this taxable income less multiplied by the tax rate. So column C22 on the input worksheet is the tax rate. We then calculate the taxes on the depreciation recapture. And this is based upon selling the assets for greater than or less than what we paid for them. So I think it may be easiest to see it from this worksheet here. We're selling these assets for this price. This is what we paid for them. So that's going to be where we get our depreciation recapture. So this is, we have taxes on the depreciation recapture. We add these two together for our total taxes, and then the holy grail of engineering economics, financial engineering, is after-tax cash flow. And that's before tax cash flow including investments, column F, minus total taxes. And you should be getting a number that looks like 12.7%. If you're not getting a number that's close to that, you need to be sure that you review with me at some point where the major differences are, because this is the number you should be getting. Now, I also calculate a present value of the after-tax cash flow. Now, I've talked about performance variables. Our performance variables are either the after-tax internal rate of return or the after-tax present value. So those are the things that companies look at. They may look at the before-tax cash flow internal rate of return, but they're looking at this number here. One other performance variable they may look at is the payback period. Now, we talked about that in another video. So you want to calculate that payback period. I do it on a undiscounted payback period and a discounted payback period. Now, because this number, 12.7%, is very close to our interest rate, our discount rate, this discounted payback period is very close to 10 years. If this number was much bigger, this discounted payback period would shoot back, but never before the undiscounted payback period. So this is the sheet that I'm looking for you to turn in. Now, however, What I want to talk about now is doing simple scenario analysis. So what that means is most people will come up with this type of a thing. They're going to get these numbers, these 16%, these performance variables here. What you want to test is, well, what if I'm wrong in estimating my doing my estimates for expenses, for example, or better yet, expense reduction per year. Okay, so let's just say I want to test, what if it's not 5,000, what if it's 4,000? We're not as good as we thought we'd be. Well, I can pop this number in here, and it's going to ripple through to the expense worksheet and into the after-tax cash flow worksheet, and it will change the present value from 12.7% to 12.1%. And we can put together a table by the brute force method of just doing trial and error here. Let's go back to our base case, and let me show you another way to do this. This is with the data table. And so what I want to do is look at what my expense reduction per year is at these different numbers. So if it's $3,000 a year, what happens to my after-tax present value? $4,000. I put $5,000 in, and I'll show you in a second why I do that. That's our base case. And the way you do this is a one-way data table. Okay? And we put in our performance variable. Let's call it the after-tax cash flow. So this is what we want to test by varying these numbers here without going through, trial and error, brute forcing it. Now note that this has to be done on the same page where this number is, as well as this number. So what you do is with a one-way data table, you put in your performance variable you're testing. This is just a note. It doesn't have to be here. You put in the numbers you want to put in here. You highlight it. And then we go into our data and do what-if analysis. And we're going to do a data table. And our column input cell, now we don't have a row input cell, this is a one-way data table. Our column input cell is where we highlight the number we're testing. We click OK. And what this does is it populates the present value at these various, whichever variable you're testing. And the reason I have the $5,000 in there is because that's our base case. And I just want to do a sanity check. Those numbers need to be the same. Now we can do this various things, and I want to show you one more. But the things you want to test are things you think could vary. So, the revenue per ton, potentially the sales per ton. Probably are not going to be the overhead per year. Let's look at if we, let's do something like this. We're going to test the after-tax present value, and we're going to look at the working capital. Okay. Be nice if I spell it right. Because this is money we're not really using. So working capital is $90,000. Okay, so we're going to say this is, it doesn't have to be the present value, but I'm just going to do the present value. That's what we're testing. And let's say we're going to test it from 70,000. So if we're better than we thought we were going to be, 30,000. And I'll turn those into dollars. So now we have our variables here that we're going to put in. We highlight this range, data, what if analysis, data table, and our column input cell is going to be the working capital number. And what this tells us is that if we are able to run this company on less cash, from $90,000 to $70,000, we increase our present value by almost 50%, from 22 to 33. On the other hand, if it takes more money to run the company, we almost completely eliminate our present value. And then what we can do is we can take these tables and we can put them together in charts. Once we've done the variables we're going to test, and I would test anything that's associated with revenue over reasonable ranges. We can test our investments, but those probably, other than working capital, aren't going to change much, because that's probably the thing we know the best, because we're really not estimating anything. Now, we probably can't really change the tax rates, other than if we were thinking we would build this thing in another state. And the state tax rate would be different. We can't change the minimum rate of return, okay? We can determine what the minimum rate of return, the present value would be at various rates of return, but really that's a company-decided policy. So this particular what if I did here basically calculates the present value at various discount rates. So if they happen to have a 10% rate rather than 12%, it would create $91,000 of value rather than 22. But again, companies can't. It's a company return. And then I did various things here. Revenue per ton, expenses per ton are shown there. What's happened to the net present value. And then I take, if we look at this expense per ton, what I did was I calculated the percent change in this variable, expense per ton, and the percent change in the net present value. Now what that allows me to do is it allows me to plot multiple variables on a chart. So I can, because now the x-axis has been normalized to a percent change, and like here for revenue, now I can plot these together here. It'd be harder to plot these numbers together as well, and then these are close. But percent changes are easy to plot, so then you can plot 2 or 3 on a chart and determine by slope which one is the most important. The steeper the slope, the greater the variation. So, for example, if I were to change startup expenses by 10% either way, it's probably not going to impact the present value. Well, startup expenses might impact the present value quite a bit. Overhead per year, if I were to change it 10% in either direction, probably isn't going to impact the present value a whole lot. But you want to find what you're looking for here, and this is what's going to separate you from your peers, is you want to test the sensitivities and find which variables this performance variable, your after-tax cash flow or internal rate of return, are most sensitive to. Those are the ones you want to determine what it's most sensitive to and find out the confidence that you have in your estimates for those variables. The reason is because you want to be sure that, if you're doing this for management, that you've given them all the information they need to make an informed decision. Now again, this after-tax cash flow worksheet is all that's due. However, the sensitivity analysis, which is a portion of your deliverable, your final deliverable, if you look at this, you have everything done to get this completely done now. So when this is done, you should be getting 40% of your project is done. This 25 and the 15. This assessment of uncertainties is significant, and so be sure you spend the time looking at those. When you write this report, I strongly suggest that you don't use AI to write it, because it's actually fairly easy to determine that you've used AI to do it. So I will grade it accordingly. So at any rate, again, this is due the day after Thanksgiving break, but you have all the tools to put it together right now.